Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. And for those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, whether that's weekly, bi-weekly, whenever you get paid, once a month, quarterly, once a year, whenever you get your tax returns, whatever that investing schedule is, being consistent, dollar cost average, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend, and companies with a high return on their invested capital. I cover all my investments into the portfolio on this channel. I do not have a paid Patreon account. That's what this particular video is, the portfolio update. We did add $2,460 into the portfolio, so we'll cover exactly what I bought with those funds. I also do options, so we'll cover any options plays I was in for the week, any dividends paid out, just any sales. No sales this week, but I will cover those if I reallocate funds, if a company's run up, for example. Maybe I trim the position and move some funds over. I cover all that. It is free to see what I'm doing. I do not have a paid Patreon account, any paid paywalls, and any other site that I'm going to send you to, or anything that you have to pay for. We all have enough to pay for. But if you would like to help out the channel, if you are new here and you have not done so already, go ahead and hit that thumbs up. If you are a dividend growth investor, hit the subscribe button. Join us on this journey to financial freedom. Hit the bell notification so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you invested in this week. Doing all that really does help out a small YouTube channel like mine grow. It helps get the word out, and I really do appreciate it. And again, to all the subscribers out there, I really do appreciate it. The channel continues to grow because of people like you, and that's why I do it. So hopefully you're getting something out of these videos. And again, for those of you who have not done so, take a minute. Hit those buttons down below. It only takes a second. It doesn't cost you a thing, and it really does help me out. Now, let's jump into the portfolio update for the week. And I do these every Sunday morning at 7:30 a.m. So it is something that you can continue to watch and see a real portfolio built out over time. That is also really the reason I set up the channel, was to help give people a little motivation and a little encouragement that you too. I do not have a background in finance or go to college for finance. I didn't come from a wealthy family. I'm learning this as I go. So hopefully you can learn along with me, learn from any mistakes that I make so you don't make them as well. And again, so you can see a real portfolio built out over time and the ups and downs associated with a real portfolio built out over time. Now into the weekly update. We started out on April 15th. On Monday, we did get into a couple of covered calls. We opened those on the 15th. The first one was for Johnson & Johnson, ticker J&J. The covered call expired April 19th, which was Friday. Strike price was $152.50. Again, a covered call. That's why it says call there. So that just means that I own 100 shares of J&J. Excuse me. This is for one contract. So one contract is for 100 shares. I received 60 cents per share for the contract, minus some fees here. All total $59.45 for that one. The other one we had hit was for BABA. Same open date on the 15th, right? Sold to open, covered call, $75 strike price on BABA, ticker BABA, with the same expiration date, April 19th. We received 22 cents per share for that one, so minus the fees, $21.45. All total, $80.90. These both did expire. Excuse me. These both did expire worthless. So basically that means I keep the shares and I keep the premium, right? This is a way that I am generating a little bit of extra income with the positions already in the portfolio, and then taking this additional income and reinvesting it back into the portfolio. Now, we also received some dividends this week on April 15th. Realty Income paid out, ticker O, $59.79 in dividends, and we do have the DRIP set on this portfolio. So that it stands for Dividend Reinvestment Plan, and it basically just means anytime a company in the portfolio pays out a dividend, in this case Realty Income, ticker O, out of the real estate sector, those funds, the $59.79, go right back in and buy more shares of that company. So we picked up 1.15294 more shares with this $59.79, and those new shares, one in fractions of a share here, added an additional $3.54 in passive income over the next calendar year. Excuse me, my sinuses are bugging me a little bit today. So that is also that dividend snowball in effect, right? So we already have shares of Realty Income in the portfolio. Those shares pay out dividends. Those dividends pick up more shares. Those shares add additional passive income. That is that dividend snowball. When you hear the term dividend snowball, that's what it means. It's basically the compound interest building on itself over time, and that's with you adding new capital or without you adding new capital. If I don't add any more funds into Realty Income, if I don't buy any more shares, the dividends will buy more shares every time this pays out, and this does pay out monthly, so it'll pay out 12 times a year. So right now, based on the price of it, I should get over 12 shares, about 13 shares over the next calendar year with just the funds I've already got in there. Now, it's going to work faster if you continue to add to those positions, and that's what I do. Right now, Realty Income is down below my cost basis, so I'm continuing to nibble on it every other week, once a month. Whenever I have a little bit of extra funds, it's one of the positions that I am adding to over this, at least the next month, while it's below my cost basis. Now we get into some of the new funds invested for the week. We added on the 15th $1,170.71. And with those funds, we added to our valet position, ticker VALE. This is out of the material sector. We picked up 6 more shares at $12 per share. We added, this is the newest position that I've added, Starbucks, ticker SBUX. We added 4 more shares at $85.35. This is out of the consumer discretionary sector. We added 2 more shares to our CVS Health Corporation position, ticker CVS, at $68.99 per share. This is out of the healthcare sector. We added 4 more shares to our Comcast Corp position, ticker CMCSA. We picked up those shares at $39.21. These Comcast is out of the communication sector. And we added 4 more shares to our American Water Works company, ticker AWK. This is a utility company at $115.62. That puts us right at 100 shares. So we may add a couple more shares next week. We may add a couple more shares the week after, but we're pretty close to being done building out the shares. We're just going to let this one compound over time here. But we wanted to get to at least 100 shares, so these 4 shares put us at that. And this $1,170.71 and the new shares it added an additional $37.24 in additional passive income over the next calendar year. And we weren't done yet on the 18th, so this is Thursday. We added an additional $1,289.53. And with the market pulled back as much as it did this past week, I wanted to add a little additional into the portfolio. This is not what I typically add. I usually add around $1,400, $1,500 a week. I have some money sitting in my savings account, which I always keep a emergency fund account, and that's my high yield savings account. And you should be doing the same. Make sure you're not just building out your investing portfolio. Make sure you have 3 to 6 or even a year's worth of your bills. And when I say your bills, that should be your mortgage. If you have a car payment, your insurance. What does it cost every week to get you back and forth to work and gas? What does it cost every week for you to eat? Don't worry about entertainment. You can cut out entertainment if you absolutely had to, but I do at least 6 months of your bills in a high yield savings account. So if you have to dip into them or you have an emergency, that's what it is. It's an emergency fund. If you have an emergency, you have the funds set aside. You don't have to dip into your investing account, right? So I have some money set aside in my emergency account that I added, and again, added a little bit more this week with the pullback. So $1,289.53 invested on April 18th. And with those funds, we added 1 more share to our Medical Properties Trust, ticker MPW. This is a REIT out of the real estate sector. We picked up that share at $4.94. And we've been doing that pretty much every week whenever we have a little bit left over. These are in reverse order as well, so they go from the bottom to the top. But if I have enough to pick up 1, 2, 3 more shares of medical properties, I've been doing that. I haven't really been adding a significant amount, but every week I've been adding a little bit to it. So we picked up 10 more shares of AT&T, ticker T, at $16.16, pulled back below our cost basis, so I want to add a little bit more there. Pfizer, same thing. It is well below my cost basis, so we added 6 more shares to our Pfizer position, ticker PFE. This is out of the healthcare sector. AT&T is out of the communication sector, if I didn't mention it. Those 6 shares we picked up at $25.35. I feel like this one is really cheap right now, but I am getting a little heavy on this position, so I'm not going to be adding a significant amount more, but I wouldn't mind adding another 10 to 20 shares while it's pulled back under my cost basis. We added 10 more shares to our HP Inc. position, ticker HPQ. Now, this is out of the information technology sector. Again, another one that recently pulled back below my cost basis, so I'm adding there $27.92 per share on that one. We've been adding at least one share of the Schwab Strategic Dividend ETF, ticker SCHD. This week we added 2. This is below our cost basis, so we added 2 shares at $76.17. And our weekly ad, same one, VTI and SCHD, I'm going to be adding at least 1 share. We did only add 1 more share here, the Vanguard Total Stock Market ETF, ticker VTI, at $249.40. Again, if this one was to pull back significantly, the overall market was to pull back, let's say 10, 20%, and be in a territory where it's really pulled back significantly, correction territory, 10 to 20% pullback is what they consider correction territory. It's only been down about 3 to 5%, so it's really not even correction territory yet. But if it starts to get in that correction territory, then I will probably add a couple shares. But SCHD was down enough I wanted to do that. VTI isn't quite there yet, so I just added the 1 share. And we did add 2 more shares to our Johnson & Johnson position, ticker J&J, out of the healthcare sector at $145.01. All total, this $1,289.53, and the new shares added an additional $49.25. Total invested for the week, $2,460.24. And with the passive income added from these additions, the additions we saw on the previous page, plus the dividends paid out from Realty Income, we added an additional $90.03 in passive income for the week. Very nice to see. And a quick run through the sector weights here. Communications is making up 10.07% of the portfolio. Consumer discretionary sitting at 4.63%. Consumer staples, and this one here, consumer discretionary, as long as Starbucks stays under 90, and BABA we may even nibble on a little bit if it stays under my cost basis. I think my cost basis is around the $73 range. I think it's dropped down in the $69 range. So I'd like to build this position, this sliver of the portfolio out a little bit, and continue to add to BABA and Starbucks here over the next over the next month or so. Let's say Starbucks maybe a little bit longer if it stays under 90. BABA, we're over 100 shares now, but I wouldn't mind getting about 10,000 invested, so going to 120 to 130 shares in BABA. We'll see. Again, as long as it stays under my cost basis, I'm going to continue to add to those 2 positions. And Starbucks, even if it's over my cost basis, so long as it stays under 90 is where I want to see it. Consumer staples sitting at 10.87% of the portfolio. Energy makes up 6%. Financials at 6.36%. Healthcare makes up 14.50%. Industrial, this is the largest piece of the pie. So I won't be adding a significant amount to J&J or Pfizer or CVS even. But right now they have pulled back significantly. So I am going to nibble a little bit. Industrials makes up 6.85%. Technology sitting at 6.92%. Materials at 11.21%. Utilities makes up 9.49%. REITs sitting at 10.89%. And ETFs, still the smallest sliver here at 2.21%. Now, what a lot of you like to see from week to week, and I'm going to show you from week to week, whether my portfolio is up, whether my portfolio is down, whether the market is floating sideways and I'm floating sideways. I'm going to show you the ups and downs of a real portfolio built out over time, so that hopefully those of you who have not started your own financial investing journey can get some confidence, some encouragement that, again, just an average person can do this. You don't have to pay someone to manage a fund for you. You can pick out your own individual stocks if you want to do the research. If you don't want to do the research, you should just stick to ETFs like VTI or SCHD or VOO, VOO. VOO is the S&P 500. That's the one Warren Buffett would recommend. VTI is just the total United States stock market. You know, either one of those would be good. SCHD or VYM are dividend growth ETFs that you can invest in. If you don't want to do any research, at least invest into ETFs, again, once a week, bi-weekly if you get paid bi-weekly, once a month. Whenever you get your tax returns, once a year, whatever it is, be putting money away. In my opinion, it is the only way to get to financial freedom. Buying assets, dividend growth investing is what I believe is the best way to do it. But if you're a growth investor, that's great too. Just make sure you're consistent, right? Whenever you see pullbacks like the red, That shouldn't be a time that you jump out of the market. That's, oh my goodness, my account's gone down. I need to sell. No, it should be like when you walk into a store and you see a sale. If you are going there to buy something and what you were going there to buy is on sale, would you turn around and walk out of the store and be like, no, I don't want to buy that now that it's cheaper? No, you would walk in and you may even buy two of them, right? You may even buy more. Those are the times whenever you see the big pullbacks, whenever you see that red, if you thought it was a good investment, if you've done your research and you know it's a good company and you understand how they make their money and you understand their margins, their profits, is their revenue growing? What does their balance sheet look like? You know, they have more assets over liabilities. Do they have more income coming in than they have debt? You should know how to read a balance sheet and income statement. If you don't know how to do that, again, stick to ETFs. But if you've done the research on the company, just because it pulls back and you have figured out a price you want to pay, you know, like I was willing to pay $120 for AWK, American Water Works. Well, if it's 118, you know, I bought it this week at 115. If it drops below 119, if I was willing to pay 120, I should be willing to pay 118. Now, if the fundamentals of the company have changed, you know, their margins get out of whack, all of a sudden they take on a bunch of debt that they didn't have before, they sell off part of the business or they get acquired by somebody, something with the business changes, their revenue goes way down. If something like that happens, then yes, maybe you need to do more of a deep dive and maybe you need to get rid of the company and sell out of it and find another position. But if the fundamentals of the company are changed or have not changed, if the company pulls back, that's when you should be adding more. So I look at all these red as buying opportunities, right? And there's more buying opportunities in my portfolio right now because the market has pulled back. So that's just the way I look at it. Now, in this particular column, what we saw on the previous page was the sector weights. This is all the individual tickers here, individual positions, how many total shares I own of each, the current price as of the close of business Friday, the market value as of the close of business Friday, my average cost per share, my purchase price. So this is how much I have into each position, right? I have $6,023.50 invested into Ally, but it's up significantly, right? It's up 52.66%. So the market value is $9,195.38 because it accounts for the $6,023.50 I invested in plus the $3,171.88 that it's up, right? And that's what I'd love every position to look like that. But again, I look at the ones and I'm not adding to Ally because it's up so much. I look at the positions in red as the positions that I'm willing to add to. Or if they're within 15% of a 52-week low. They could be in the green if they're within 15% of a 52-week low. But if you see here, Ally, 15% of its 52-week low is $25.92. It's currently at $39.05. So it's not even close. So that's why I'm not adding. And as you can see, if it's red, that means I'm down. Here's the percent return. So again, green I'm up, red I'm down. So you're going to have positions in your portfolio that you're up, some that you're down. You're not going to hit on all of them. Even the best investors in the world have misses. That's just part of investing. What sector each position falls in, whether it's a quarterly, monthly, semi-annual payer, the current dividend yield as of the close of business on Friday, my yield on cost in this column, how now on the previous slide we saw the sector weights. This is each individual is weighting, right? Right now, Johnson & Johnson is my largest individual position. It makes up 7.11% of the portfolio. I do have a rule in the portfolio. I do not want any one position to be more than 10% of the portfolio, and I do not want any one sector to be more than 20, possibly 25% of the portfolio. So Johnson & Johnson is getting close, though it's kind of pulled back. It was around 9% of the portfolio at one point. With the recent pullback, it's dropped back significantly. And healthcare sector is my biggest sector as well. Estimated annual income in this column here, payout months here, the dividend growth year over year, and where it sits at 15% of its 52-week low. I touched on this a little bit. Let's look at BABA, for example. Right now, again, I will buy this up to $76.62. It's currently under its cost basis at in the 69 range. So I'm going to continue to nibble on that. But let's say this jumped up to $74, $75. Well, I could still add to it technically because it's under 15% of its 52-week low. But let's say it jumped up to even $78 or $79. Well, if I was still interested in building that position out and adding to it wouldn't take, see, $73.46 is under 15% of its 52-week low. If adding to it wouldn't take this number, my average cost per share, above where it sits at 15% of its 52-week low, I may be able to nibble a little bit there. right? But I want to keep my cost basis under where it sits at 15% of its 52-week low. This gives me kind of the top of where I want to pay for this position, or where I want my average cost per share to be, really. So all total, we have 6,200 or 6,426.616 shares. The market value of the portfolio is currently $237,618.62. I have invested $232,787.77. We are up a little bit, $4,830.85. This is not what I pay attention to. Up 2.08%. Again, not what I pay attention to. I've said this when I was down 4-6%. I've said this when I was up 6-7%. I don't care about these numbers, right? I mean, obviously, I like to see that I'm up. That means that I'm not losing money in the overall in the market, even though some positions are down. Overall, I'm not losing money, but that's not what I'm paying attention to. Current dividend yield as of the close of business on Friday, 4.411%. Yield on cost sitting at 4.503%. That's why I have it circled in red, is what I focus on. Whether the market's up, whether the market's down, whether the market's floating sideways, this estimated annual income, the dividends paid out by all the positions in the portfolio, the passive income created by the portfolio overall, currently sits at $10,481.78, and this grows week over week, month over month, quarter over quarter, year over year, as I add new capital every week to the portfolio, as positions in the portfolio pay out dividends, like Realty Income paid out dividends this past week, right? And as the positions in the portfolio increase their dividends. So that's why I have these ones highlighted in yellow. So far, these are the ones in the portfolio that have increased their dividends for the year, right? So again, $10,481.71. Over the next month and a half, I will probably cross the $11,000 range, and I will definitely cross over $12,000, if not $13,000 per year in dividends by the end of the year. So really looking good. The portfolio is really starting to grow. That dividend snowball effect is really starting to increase now. And here, the dividend growth right now is sitting at 5.83%. Over the calendar year. So even if we weren't up or down, we're seeing dividend growth at 5.83%. And that basically, that number represents the increases in dividends the companies pay out over the calendar year. Now, this may adjust as they adjust those percentages. You know, if for example, Valet pays twice a year, you know, this is their high month or high payment, this last one. Their next one is a little bit lower, so that's going to adjust right there. Same thing with Owens Corning. Owens Corning may not pay out a 28.74% increase in their next dividend payout. I would love it if they did, but I'll adjust it whenever their next dividend increase is accounted for, right? So that may adjust down or up. And same thing with any of these. We see some zeros here. Kraft Heinz, for example. I knew this buying this 3 years ago, that they were not increasing their dividend. They're still not increasing their dividend 3 years later. This is one that I'm hoping starts to increase their dividends again. And I am saying to myself, if they don't do that next year, I'll have given them 4 years, which I feel like is enough time to start increasing those dividends again. And I don't even care if it's a small increase, right? Verizon, for example. A lot of people stay away from Verizon because they think it doesn't have much dividend growth. Well, they're paying a 6.57% dividend, and they're still growing it at 1.93%. So, and I know a lot of people say, well, I want more dividend growth. I want more dividend growth. Well, I'll tell you what. Owens Corning is is growing their dividend at 28.74%. It's going to take, and their current yield is 1.5%. Now, my yield on cost is 2.5% because I bought them a long time ago, you know, when they were down 73% lower than where they currently are. So I'm up significantly on that position. But I will tell you, if you were buying Owens Corning now with a even if you were buying them back then with a 2.599% dividend yield, even with 28.74%, it will take decades, not 10 years, 20 years or longer for Owens Corning's dividend yield, or even your yield on cost, to catch up to Verizon, 6.57%, even with 1.93% growth. So don't be afraid to get some of these slower growers that are paying much higher dividend yields to help juice your income a little bit. especially if you are older like I am. I'm in my mid 40s, so I want some income. That's what I'm looking for. I'm trying to retire off dividends, right? I don't want to work forever. So I still plan on having my portfolio for decades. So I want some of the higher growth, lower payers, right? Because in 20 years, these will be nice positions. But it will take them 20 years or longer to catch up to positions like Verizon, even if Verizon only continues to grow at 1.93%. And they would only catch up if they continue to pay out 28.74%. But what typically happens is these positions that are paying faster growing dividends have a lower payout ratio, and Verizon's isn't even that high. They're only in the 50% range for dividend payout, so they could increase this at some point. But these companies like Owens Corning, who have a lower payout ratio, so they're increasing their dividends faster, at some point that will shift. When they start to get to 60, 70% payout ratios, they will not continue to raise it by 28.74%. So they may never catch Verizon. So I think I hear a lot of other dividend channels out there, and I follow a lot of other dividend channels out there, really push dividend growth. We want dividend growth. We want dividend growth, and forego some of these higher dividend payers with slower growth, thinking that, oh, well, and they'll show you a dividend calculator, and it will show that eventually Owens Corning will catch it. Well, that's maintaining exactly the same growth, which is highly unlikely. These dividend growth go up and down from year to year, which is part of the reason I show it. It's not always the same number every single time. And these slow growers with the very high dividend yields, even like Enbridge up here, ENB with a 0.02, and EPD, Enterprise Product Partners, with a 5.2, that's actually pretty decent dividend growth, 5.25% with a 7% dividend yield. A company like Owens Corning, if it maintains 5% with a 7% yield, it's never going to catch it, even with 28.74% dividend growth. So there is a little misconception that you should focus more on dividend growth if you're a younger investor. I don't necessarily agree with that. It should be part of your overall dividend investing criteria or strategy, but it should not be the main thing you're focused on, because you are passing up some good positions with very high dividend income that could help you retire sooner by just focusing on low paying yield, high growth, which is fine if that's your strategy. But I think it's a flawed strategy, because again, these positions like Owens & Corning, it's going to take them decades to catch a company like Verizon with a much higher dividend yield, if they ever do. Well, that is really it for this one. As always, appreciate you stopping by. And if you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think. What did you invest in this week? What companies paid out dividends? Are you running any options? Would love to hear from you. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. I do a stock pick of the day series. So if you have a company you'd like me to cover in that, go ahead and drop it down in the comment section below, and I'll try to work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. I hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk against money. Should never invest any amount in comfort losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek lead advice, counsel, as a certified financial advisor.